Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and as I like to remind you each and every week, I also write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and Chen Lin, a partner of mine, writes a newsletter called What is Chen Buying? What is Chen Selling? Chen's on vacation now down in South America with his family. He'll be returning in a couple of weeks, I guess, from now. But in any event, we do want to get him on our show again sometime in the not-too-distant future. Well, to sign up for either Chen's letter or mine, go to miningstocks.com, miningstocks.com. Or you can call our office here in New York at 718-457-1426, 718-457-1426. Do want to thank each of you for listening, making this show one of the more popular shows on the Voice America Business Channel, and for sending along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com, and you can follow me on Twitter under J. Taylor Media. We do want to thank our sponsors for making the show economically viable. Our sponsors for today's show are Tri-Metals Mining, Coral Gold Resources, Aran Resources, Brazil Resources, and Columbus Gold. We do have a very busy schedule today, so we're going to hop right into the show, talk about the show. I've titled it today, Can Helicopter Money Overcome Global Deflation? And John Rubino will be with me at about 1:30. Michael Oliver is with me now, and David Wolfen will be joining me after our first commercial break. The major question facing markets now is whether this the global monetary mess created by Keynesian economists will be resolved by way of deflation, a deflationary implosion, or an hyperinflationary wipeout of the existing order and the mess that's been created by these guys. Well, no one has remained as objective with respect to that question as John Rubino, and John will be with me at about 1:30. In light of Brexit, insolvent Italian banks, recent warnings from Alan Greenspan and Michael Oliver's work suggesting a final blow-off in the T-bond market, I will definitely want to ask John if he agrees with Greenspan's recent concerns about inflation as voiced on Bloomberg a few weeks ago. David Wolfen will be with me to talk about Coral Gold. That's a company that he heads up, and one that is starting a new chapter in its history. Coral just sold a property to Barrick Gold for almost $16 million US, leaving it with cash on its balance sheet that actually exceeds its current market cap, and it has a royalty in that property and other properties as well. So at its current price, it seems to me that Coral provides good upside potential, assuming, as I do, that we are in a bull market of some duration here for gold. And, of course, we want to get Michael Oliver's thoughts on that again, as always. Theories about the economy and where markets will go are all good and dandy, but most of the time theories don't work out exactly as we expect, or if they do, the timing is way off. So as the old adage is that timing is everything certainly makes a lot of sense. At this point in time, the direction of various financial markets certainly, in my view, look uncertain. And so I'm really glad that Michael Oliver could join me. Again, thanks for being with me, Michael, and we want you to help us.
Back, Jay.
Always good to have you, and always good to know you do help me feel somewhat more certain about things after I speak with you, and that's one of the reasons I like to have you on almost every week whenever it's possible. Well, you talked about the T-bond market, the 30-year U.S. Treasury. It's probably the biggest and perhaps the most important market in the world, I would say, and you've been talking about the potential for a blow-off here in the T-bond market. That could reverse, I believe, a decades-long bull market. Do I have you right on that, and do you still see it that way?
Yes, you got me right on that. I would lump into that also the German Bunds, which is a 10-year maturity instrument, and considered, safe, just like U.S. T-bonds, T-notes, so forth. And the JGB, the Japanese government bonds. Which is also it's traded in futures as well. All of these are futures traded markets. So I'm focused on the 30-year futures, U.S. German Bunds futures, and JGB futures. I've run reports on them for my clients, and the technical situation in all three is very, very similar. So that reinforces my concept that if the T-bonds are in blow-off, and I think they're in the early part of it, my only problem is when does that turn down? And I don't mean a problem, it's something I have to measure for. And so I'm looking at all time scales of my metrics. I'm not just looking at long-term momentum, I'm looking at intermediate stuff, the kind of stuff that shifts trend every 3 to 5 months, for example. Because frankly, any downturn now could be lethal. That it was something of a modest scale could morph into something of a large scale, like one domino hits another type thing. But what's interesting is that the JGBs, the bunds, and the T-bonds all are in basically the same technical condition on their long-term charts, which indicates they're in a blow-off, and two, they're in decent proximity to intermediate term downturns. So in other words, if they sneeze too much on the downside, they could start breakage that direction, meaning that the blow-off is ending. Now, it's interesting because their clocks are a little different. The JGB's been in blow-off for 6 months, by my measure. The U.S. Treasury bond's only been in a blow-off above the point of acceleration for 2 months. So there's a slight bit of difference there. So that's the only issue of confusion for me. It's not that we're in blow-off. That's pretty clear. That means vertical upside action as opposed to a gradual bull trend. It means it's verticality. Two, the implication of that is when it fails badly. Blow-offs do not end gently. They end with collapses. Not all bull markets end with blow-offs, but the ones that do end badly. And all three are set. All three of these markets are set for a downturn of significance. They're not near the trigger numbers right now, but the trigger numbers are definable. So it's simply a matter of momentum structural analysis, continuing to monitor these three markets as a trio.
All right, so you could see a real, I guess, global systemic issue here. If one goes, would you expect one could go without the others going?
All three go. Yeah, I think all three go, and these are the three, quote, safest debt instruments around. Now, two of them are negative rates.
Yeah.
Zero, down to zero. So only the U.S. has a 2% plus yield on its 30-year, but which is still very low, and it may get under 2 before it's over with. But I don't see us going to negative rates on the 30-year. But regardless of that issue of the difference in the rates, their technical structure is, especially on momentum, long-term and intermediate, is basically their overlays of each other. So I'm very happy with that, because what that does, it makes my job easier in terms of declaring a downturn, because I will have a chorus, not a sole singer, but the three guys. Okay.
Right. Well, it maybe makes your job easier, but I just have to think that what we're talking about here is something that's very, very big, potentially something that's very big in terms of the other markets as well. And we have to ask you about the dollar in light of the T-bond. If the T-bond goes, what does that do to the dollar? You'd think the dollar might get weaker.
I'm thinking the dollar goes down. The dollar rally now has gone a little further than I thought, but it doesn't change anything. Really, the dollar and the euro, which is the two biggest Forex markets out there, the dollar index I'm talking about, of which 57% of that index is comprised of the euro. Those are the two deadest markets on the planet this year in terms of volatility. In fact, if you could draw a line sideways, they just basically breathe either side of it. The dollar right now at 97 area is about in the middle, slightly maybe in the upper half of last year's whole range. And it's a very unvolatile situation. I think the dollar rally, which is, again, right around 97, if it slips in the next week or two down to about 96.5 on a weekly close, so I'm talking about a half a point, I think it could be over. The rally that's been underway for, well, actually, it's very interesting in this regard. The dollar index made a significant low the same week that the S&P made its mid-February low. So to some extent, the dollar advance, which is zigzaggy, is in sync with the upturn in the S&P. So consequently, if the dollar turns down and the euro turns up, which would be the obvious relationship, that may have implications for the S&P at that point in time.
Right. Interesting. Well, we don't. Yeah. Well, we'd love to hear more about the S&P, Michael, but time is limited. My engineer tells me we have less than 2 minutes. So, gold, how is that looking now? Still bullish as ever? You're still looking for high 1400s?
Yeah. Now, there's nothing really new that I can add that I didn't say last week and the week before. Really, it's stuck in the middle of a first major wave of upside. That wave began at a breakout level of 1140 to 1160 in February by our metrics. And right now, this congestion in the low to mid 1300s is next to meaningless. It's just congestion. The next major resistance and first major target of a longer-term bull market is between 1470 and 1540. It's a broad zone, but we're not there. So, frankly, I view this as just sideways congestion for the last few weeks. And and by the way, it's done that for the people who believe that the dollar must be weak for gold to go up. They're wrong. I've never bought into that argument. The dollar has not been weak, and yet gold has been quite strong. So.
Right. Yeah, so there you can put that theory aside for sure. Well, if we get a period of congestion here, Michael, I think it probably gives us a bit more time. Those folks that might have felt they missed the train as it pulled out of the station when it come to buying the gold shares have a little bit of time now, maybe to load up before the next move, huh? So
I think so.
That's
we just had a $3 pullback, and I think probably in this general area on the GDX, for example, the 27, 28 area is a reasonable place to be looking. Our buy signal was at 1550, but I mean that's history. So now you have to buy secondary dips, and this $3 pullback from the recent high is reasonable.
Yeah. So well, thanks again, Michael, for being with us, and we'll look to do it again next week, hopefully. Thank you so much.
Thank you, Jay. Bye bye.